Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, last week's shock was the start, but this week, things feel different. What's changed?
You're absolutely right. It's no longer just about tariffs. What we're seeing now is a broad-based rejection of U.S. assets, equities, bonds, and the dollar. Usually they don't all move in the same direction. But this week, they're all falling. That's rare. That's telling. And the trigger? Trump announcing an additional 10% tariff on Chinese imports, taking the total to a staggering 145%. Markets had just staged a massive relief rally on hopes of compromise. Then, boom, more tariffs, more uncertainty, and the VIX exploding to levels we haven't seen since the financial crisis. This isn't just volatility anymore, it's a vote of no confidence.
And the inflation picture? The data looked softer, but is that the full story?
Not even close. Yes, March CPI came in lower. Headline inflation actually declined 0.1% month on month. But let's be honest, that was gasoline prices doing the heavy lifting, down over 6%. And guess what? They've already started rising again, up 3% in April so far. More importantly, markets aren't buying the inflation dip. CPI swaps are now pricing inflation at 3.6% over the next few months. The tariff effects haven't even started to show up yet. Once they do, companies will face higher input costs, and even if they've stockpiled some goods, they'll likely raise prices, because they can. So yes, we got a breather, but don't exhale just yet.
Just a few days ago, markets rallied on the 90-day tariff pause. Was that just false hope?
Pretty much. Trump called it a pause from the heart. Markets called it a sugar high. The S&P surged 9.5% in one day. Nasdaq jumped 12%. It was the kind of rally you get when everyone is short and suddenly scrambles to cover. But here's the catch. It didn't include China. And that's the key player. Without China in the deal, there's no meaningful de-escalation. And now, just days later, we've reversed much of that rally. The White House hit the panic button, but left the most dangerous fuse lit.
Let's talk about safe havens. Gold is screaming higher. What's driving that?
Gold's not just creeping up, it's tearing through all-time highs, now well above $3,000 an ounce. And it's not Reddit traders or gold bugs driving it. This is institutional money. This is central banks. This is the quiet consensus that the U.S. is no longer the rock it once was. It's also about inflation. It's about dollar weakness. It's about geopolitical risk. Gold is doing what it always does. It's telling you something is deeply wrong. And right now, that message is loud and clear.
Final thought. What should investors be doing right now?
3 words. Stay globally diversified. This isn't just a U.S. story anymore. We're entering a phase where the myth of U.S. exceptionalism is being tested and repriced. The S&P still trades at a hefty premium to Europe. If that unwinds further, we could see another 20% relative underperformance. Add rising recession risk, a boxed-in Fed, and fragile corporate confidence, and suddenly it's not about stock picking, it's about survival. So, don't take profits on gold. Don't chase the next bounce in U.S. tech. Look at Europe, look at Asia, look anywhere that still has policy flexibility. And yes, it might be time to rethink your dollar exposure too.
That's it for this week. Stay tuned for more insights next time.